Hello, and welcome to Navigating Seasonal Cycles with Jake Bernstein. The information provided in this episode is for educational purposes only. There is a risk of loss in all trading and investing. The results shown are hypothetical and should not be construed as investment advice. And now, over to you, Jake.
Greetings, everyone. Thanks for being here. I appreciate the opportunity to present to you. Again, I apologize for the voice. I'm beginning to sound like a gangster, but I think it's going to be fixed. I want to thank everyone for the New York conference. It was a fantastic show. Even though I couldn't attend in person, it was quality all the way from the speakers to the presenters to the organization. And we owe a great deal of thanks to the people at the Foundation for the Study of Cycles who did all the hard work. I didn't do much. I couldn't even attend. I was having throat surgery. But it was a great presentation by the other speakers. And I had an opportunity as well to make a recording and have them play it. So I'm glad everyone had a good time. I got nothing but good feedback. So I will try and be as loud and clear as I can here. But do know this. It's not terminal. It's getting better all the time. And it's just a vocal fold procedure which has been perfected. But it does take time to develop and improve. So what I want to present to you today will be both interesting as well as potentially polarizing. Some of you are going to hate it. Some of you are going to love it. Some of you are going to glaze over. Your eyes will glaze over and you'll say, I'm not interested in this. I can't do this. My goal, of course, is several-fold. Number one, to demonstrate to you the fact that cycles are all around us. Number two, that the cycles we use for financial implementation are very specific, very clear, and very effective. Some of the things that I've seen with cycles in finance and in markets have truly blown me away. They're more than pragmatic. They're actually profitable. And although I won't give you any guarantees, I will show you some patterns that are money-making if you use them correctly. Remember that the weakest link in the chain is always going to be the individual. The implementer of the methods will always be the weak link in the chain. So let me begin by showing you this chart. The most interesting chart and certainly a very dynamic and heading up most of the time. What is this? This is a chart of a pairs trade. Costco versus Walmart. And what it shows is this. Since the 1990s, late 1990s, the curve has been very, very much to the upside. Indicating what? Indicating that the stock of Costco has been gaining steadily over the cost of Walmart. So for equal dollars, if you had put $100 into Costco and $100 into Walmart, your $100 in Costco would have risen to at least 500, 600% compared to the gain in Walmart. Clearly, Costco is the choice to make. That is not to say that one could not have made gains in Walmart, but the gains in Costco far outweigh. And therefore, the so-called pairs trade. Many of you are familiar with pairs trades, otherwise known as spreads, because you're options traders. And in options trading, there are many different possible spread combinations. You can buy the call, you can sell a put at the same time. You can do a put trade, you can do a seasonal trade, you can do a carry trade, you can do many different kinds of trades and spreads that are basically options trades. But there are the relationships that are cyclical that fascinate me. I give you an example of what I mean. Let's take a look at a spread relationship between treasury bonds and treasury notes. So I'm going to bring up a chart now. Let's take a look. Here we go. This is another chart that shows the relationship or the spread between the 10-year note and the 30-year bond. So all we're really doing by computer is subtracting the trading price of treasury note futures from treasury bond futures. And we get a chart that shows the difference between the two. So obviously, If you're just thinking that interest rates are fairly stable across the board, that is not the case. There are periods of time when the short-term trend rises faster in the Treasury notes than it does in the Treasury bonds, and vice versa. In fact, these moves can be dramatic. Let me see if I can measure one. So I'm going to take this tool and I'm going to measure from here to here. Distance. All like this. And this is truly dramatic, because over this period of time, being long the Treasury note future and being short the Treasury bond future created a difference of $21,000 in potential profit or loss if you're on the wrong side of the trade. Meaning what? Buying the 10-year note, selling short the 30-year bond here, resulted in this move over here, which means the Treasury note futures gained over the Treasury bonds. And then again on the way down, I'm not even talking about some of these bigger moves, such as this one. From here, approximately down to here, is dramatic. So now we know why, and by the way, this is on a one futures contract basis. Now we know why traders trade the so-called yield curve, the long-term notes versus the short-term notes, and so forth. There's a lot of money to be made in these. But the question is this: are there repetitive patterns? Is there a cyclical pattern? Is there a seasonal tendency? Being a pragmatic kind of guy, and I want you to know, of course, that I tend to wear three hats in trading. The first hat is I'm interested in cycles as an academic pursuit. The second hat, I'm interested in cycles from the philosophical point of view. But the third hat, and the most important one for me, is the pragmatic hat. I want to know, notwithstanding the beauty and regularity of cycles, I want to know how I can use them to make money. Call me a mercenary, call me whatever you like, but that's the way I grew up, that's the way I developed, and that's what I've been doing for the last half century. So let me show you something that's truly dramatic. And again, I want to say that what I do is not perfect, but it is highly accurate and very predictable. And when we combine the process of a setup or a pattern, a trigger, and follow through, that's what does it for me. So I'm going to take this chart. I'm going to bring up my very elementary, rudimentary cycles finding tool. Not even close to what the foundation does. Not even close to what Richard and Lars have developed. This is my own, very, as I said, rudimentary. I'm going to find two prominent lows. This one here and this one here, for example. And I'm going to draw in a cycle like so. I'm going to make it fit these 2 points that I pre-selected. And I'm going to look at the chart and see, do my cycles line up? Do they have potential? So let me expand this like so. And see, what have I got? Well, I've got a cyclical low here. I have a cyclical low here. What else do I have? I have a cyclical turning point here. Not necessarily a low, but cycles don't always get drawn off lows or highs. They get drawn off starting points or ending points. So I would venture to say that from this point here, we have started another cyclical move to the upside. And we know what the length of the cycle is right over here. Approximately 1, 2, 3, approximately 4-year cycle, which is rather interesting because it correlates with the 4-year presidential cycle. But that's a whole nother story. Let's go back in time. How about this low? How about this low over here? Was it close? Can we compensate for these with timing? Remember that all we're dealing with right now is a setup. So let me add some data here. Let's go back even further. So we have one here. We have nothing here. We have a little one over here. And looking at it all, I say to you, It's interesting. It has potential. It would require more testing. Let's look at another one. The relationship between soybeans and corn. So here's the chart. Now, why would anyone be interested in the relationship between soybeans and corn? Well, pragmatically, not just withstanding for the purpose of making money or speculating. This would be of great interest to a producer, to a farmer. Why? Because in the spring, the farmer has a choice: plant corn or plant beans. Planting corn will occur on a certain date. Planting beans will occur on a certain date. And if you can't plant corn by that certain date because of weather, you still have a window of opportunity to plant soybeans later on. And so this would be of a specific interest to the producer. In addition to that, if the opportunity presents itself to plant corn or soybeans, how would the farmer decide? They would look at the chart and they would say, oh my goodness, we're due for a cyclical low in the relationship. Soybean prices are cheap compared to corn prices. Therefore, let's plant corn or let's plant beans and participate in this potential up move. Or let's defer planting a certain crop and plant a different crop. Now you may be interested in this. I'm going to try and measure these moves to see what they're worth, because these moves, although they may appear small, or you may not understand them, you will understand the dollar amount. Let's see if we can do it. So move, for example, from here to here. Oh, wrong choice. One moment, please. I need the right tool. The right tool for the right job, very important, of course. Here we go. The dollar difference tool. What is this move worth in futures? Here we go. And as you can see, this is a very large move, considering we're only doing one futures contract for each side. So how would this work? Very simple. At this cyclic low, assuming we had timing to confirm our choice, we would buy soybeans, sell corn. At this point over here, we would sell soybeans and buy corn. It's really very simple. Let me show you another one. A shorter term version of the Treasury bond spread right over here. So now we're looking at a bigger picture. And again, how do the lows and highs relate? And some of them are right on target, some of them are a little bit early, some of them are a little bit late. But we can use this work along with timing to determine exactly what to do at moment. But guess what? I'm going to take it one step further for you. What I'm showing here is very rudimentary, very elementary. Anybody with a little cycle finder tool can do it. And you can do much better with those advanced mathematical tools, such as those developed by Richard and Lars. But I want to add one more component to this. I want to add a seasonal to it. Because many times, traders reject seasonals and say they're not really cycles. Well, I respectfully submit to you that they are not only cycles, but they are the best cycles we can find. In order to do that, I'm going to switch suites and do something different. And let's go to a seasonal programming. Let me show you something interesting. I'm in a spread program here. I'm going to ask for the relationship that we just looked at. Treasury notes, treasury bonds. I'm going to ask a question. For the entire year, have there been any relationships between treasury bonds, treasury notes, spread? Remember, you're buying one, you're selling the other. This should be very easy for you to understand if you're an options trader. I'm going to ask the question. Have there been any instances in the entire year that have been 70% predictable and that have a relatively short-term duration, 50 days or less? And we're going to go down to the trader notes treasury bond. Like so. I would ask the question, show me if there's been anything during the entire year in the notes bond spread that has been correct 70% of the time. In fact, let's be greedy, let's ask for 75. About a duration of less than 50 days. And remember, what we're doing here is research. We're not inventing something new, we're finding something that's already there, if indeed it is. So we're basically asking the question, has there been a relationship that's been predictable? Let's find out. I don't know about you, but I find this to be fascinating. Because it shows at 81% of the time, the spread relationship between TQ and TT, Treasury bonds versus the Treasury notes, has been such that it went up 81% of the time. The average gain is 1.2. Now, what does that mean? What that means in dollars and cents is over $1,000. So, let's look at the history. We're looking at 43 years of history, and these are the results. So I ask you, if this relationship tends to go in a particular direction, beginning within plus or minus a day or two, November the 6th, to plus or minus a day or two, November 27th, is this not a cycle? Is this not a very predictable cycle? Is this not about as perfect a cycle as it could get, given the accuracy of 81%? And ask yourself the question, how much information of this type, or of any type in terms of history, does your cyclical methodology allow you? It's one thing to say, yes, there's a 200-day cycle in the S&P or whatever. The question is, how exact has it been? And this, my friends, is exact. You can't get more exact than this. So you must ask yourself a subsidiary question, which is, why don't most traders do this? Well, first of all, they don't understand that it exists. Number two, they don't understand how to do it. They don't know how to place orders. The idea of being in just one futures contract scares the hell out of them, let alone being in two different contracts. Although they should be familiar with it because they regularly do spreads where you long one and short the other. You'll notice I chose a fairly lengthy period of time. Let's see if there's something over a shorter period of time. So let's make it less than or equal to 15 days. Is it possible that these relationships exist in a short time frame as well? Well, we might have to speculate on it. We can answer the question by looking into research. And here's what it says. So it is August 16th through August 24th. Now, there's risk. The risk is 2 points, meaning 2.00, meaning over $2,000. The average profit is only 44.44, which would be $448. So you might say, this is not a good trade in terms of risk to reward. But I have noticed that sometimes, in fact many times, you need to be willing to risk more than you can really get in the way of a reward, especially when it comes to futures. Let's go to seasonal and see what happens there, not to the history. Go. Again, we're looking at 43 years of history. And this is what we're looking at in terms of equity. Yes, it had one big losing year, but thank goodness that's out of the way, because we're now ready to move the other way. So how much was this losing year? Approximately $1,600. But now I have to go somewhere else. Let's go back to the search. 1 moment, please. I want to ask a different question. Has there been any relationship? Yes. The currency markets has been predictable. It's when focused to the yen, the pound sterling. So, let's give it a little more time to operate. So here, 50 days. This we got here we are. A 4-day trade. Buying the pound sterling separately, Japanese yen. 78% accuracy. And the average profit's been very small, but the deal has percentage wins on your side. Let's take a look at the history. 46 years of history. There's the equity curve. So, let me summarize for you. The cycle, it's interesting. It's a seasonal cycle. The cycle is very exact to the starting date and to the ending date. To me, that meets all the qualifications for a cycle. The fact is that the vast majority of traders will have no interest in this whatsoever. This has always been the domain of the professional trader. And the professional traders are always looking for opportunities to take advantage of them. I want to end by showing you one that absolutely blows me away. Let's go back to the search. I realize that many of you do not trade the regular commodity markets like the grains and meats, but I want to show you something that will hopefully at least get you thinking. Seasonal spread charts. I'm going to go to the lead hog market. Now I understand that many of you have never even heard of the lead hog market, but remember, gold is where you find profit opportunities are where you find them. Let me show you something that you might find interesting. Lean hog futures. Excel. And by the way, for most of these spread relationships, there's a fundamental reason. We know what that fundamental reason is in most cases, which makes it more appealing to take a trade because you have confidence in it. There's a fundamental justification. Let's go to the entire year. I'm going to be very demanding. I'm going to say, I only want to see trades that have been right 80% of the time or more. That's not asking too much, is it? So let's take a look. In computer stats. Yes, it was a trade. Buying June hogs, selling April hogs, November 20th. Keeping it through March the 3rd, which is a long-term trade for most people, has been right 87% of the time. Since when? Let me show you. And this is the part that blows me away. Look at the history of this trade. 56 years. And these are the results. Now remember, these are hypothetical, assuming that you could get the price execution and show on the list. But the bottom line is this not a cycle? Is this not a seasonal cycle? Indeed it is. It's dramatic. It's definitely worth looking at. And the fact of the matter is, most people have never heard of it. Most people don't know how to enter it. Most people don't know how to exit. Question is the research. The numbers don't lie. Let's say that you didn't have the patience to hold this for such a long period of time. Let's go back and take a look at it. So we modify the parameters. Let's go back to return a search and say, I don't have the patience to hold for 50 days, or whatever it takes. I just want to see these relationships on a very short-term basis. Let's say 25 days or less. Let's do this. Like so. And you run it again. And it says, what? It's saying, we need to give it more time. Very wise. How much more time? Let's find out. Let's give it 50 days. And remember one thing that's very important. Margin. The margin requirement on hog spreads is dirt cheap. It's about $300, $400. In some cases, there is no margin. It is market to market. You're only responsible for what you really lose. But that's for another time. Here we go. And here we are. A relatively short-term trade with 83% odds of success and a history of over 56 years. Here we go. 54 years, sorry about that. And the results. Interesting. Even though I've been showing and teaching this trade for well over 2 decades, last year it had its highest ever win, which speaks to the popular misconception that if everybody knows about something, it'll never work. So, ladies and gentlemen, I want to thank you for being here. If anything I've said to you today is unclear, please don't hesitate to get in touch with me. I think I made my point. And let me reiterate. Number 1, if you don't know spreads, learn them. If you don't know the seasonality of spreads, learn it. Number 3, many of these can be done with option strategies as well. So if you have any questions, please get in touch. I'd be glad to help you. And thank you for the transition for allowing me to present this. I hope you see the beauty in what I'm talking about here. Although most people, as I said before, will be highly polarized. Most people will yawn. They'll say they don't want to understand this. It's too complicated. But many times, that's where the real money is the thing that the trading public generally doesn't understand. And the cycles, remember, are the key to this in terms of setup and trigger and follow through. We're not doing anything here without a trigger. We're simply looking at the pattern and subjecting the pattern to the requirement of a trigger. Thank you again very much for the foundation. Everyone have a great trading day.